Hey, what's up? It's Ben here. Hope you all are doing great. I know I talk a lot about dividend stocks for passive income, but what if you want to diversify yourself and don't want to put all your eggs in one basket, like how a lot of investors are talking about because it's risky? Don't worry, I got you covered for that. We're going to look at the 5 best ETFs to buy and hold for the future. For those of you who are new here to investing, ETF stands for Exchange Traded Fund, and they're basically a collection of securities such as stocks that tracks an underlying index or benchmark. The beauty of an ETF is that it's great for diversification since they can have dozens of securities or stocks in its holdings, so then you don't have to run the risk of having a huge loss if one company decides to go bankrupt. Another benefit is that it generally has a low expense ratio compared to a mutual fund. And yes, this is basically an annual fee that you have to pay, so you don't have to individually buy dozens of stocks on your own and manage it. So for example, if you see an expense ratio that is 0.05%, that means that if you invest $100, your fee is only 5 cents a year to obtain it. This isn't bad when you could be well diversified and have a growing portfolio just by paying a 0.05% fee. And lastly, one more great benefit of an ETF is that it just trades like a stock, so you can buy and sell it on the exchange easily. And for those of you who are looking for a platform to trade on and also get some free stocks while you're at it, consider checking on Weibo or Robinhood. I have links and video links down below to help you out to get started if you're interested. So without further ado, let's check out these 5 ETFs that'll help grow your account. Number 1, Vanguard Total Stock Market ETF, ticker symbol VTI. This ETF tracks the US total stock market. It has 3,529 stocks, so if you invest in it, you're basically investing in thousands of companies all at once, making you super diversified. So basically, if the entire stock goes up, your portfolio will go up as well. But if a dozen or so company goes out of business, it won't even affect you. And about 26.7% of its holdings are in technology, with Apple being its largest holding. Its return on equity is 17.6% and its earnings growth rate is 14.4%. It has a dividend yield of 1.67% and an expense ratio of 0.03%, which is really cheap for an ETF. Since inception in 2001, it has an average annual return of 7.48%. Currently, it's trading at $177.65. This ETF is perfect in terms of diversification, and if you think the overall market and the economy will just continue to go up, you're right, because based on past performance, it's been doing pretty well and it's been going up for decades. But if for some reason that's too diversified for you, check out number 2. Vanguard S&P 500 ETF, ticker symbol VOO. This ETF basically tracks the S&P 500, which are 500 largest US company. If you didn't know, the S&P 500 has been hitting new all-time highs in the past decades as well. Companies are being listed and delisted from time to time to keep the growth going, so basically you don't have to worry about a company going bankrupt on you. Its holdings are mainly in the tech sector with about 27.5% of it in there, and its largest holding again would be Apple. Its return on equity is 19.6% and its earnings growth rate is 14.3%. It has a dividend yield of 1.76% and expense ratio of 0.03%. Again, it's relatively cheap for an ETF. Since inception in 2010, it has an annual average return of 14.02%. Currently, it's trading at $322.14. A lot of people talk about this ETF because it has a really low expense ratio compared to the SPY ETF, which they both track the same thing. Granted, SPY has been around longer with more data to show. But if you want growth and a decent dividend, check out number 3, Schwab US Dividend Equity ETF. Ticker symbol SCHD. This ETF tracks high dividend yielding stocks that has a good track record of paying out dividends consistently within the United States. It has a total of 104 holdings, and most of its holdings are in the financial sector at 24.48%. Its current largest holding is USPS, and the ETF itself has a return on equity of 26.77%. It has a dividend yield of 3.01%, which is way better than the other ones for passive income. It has an expense ratio of 0.06%, and since inception in 2011, it has an average annual return of 12.55%. Currently, it's trading around $57.87. Since tech companies are really popular and growing like crazy in this decade, we can't just simply leave them out of the picture, so here's number 4, Invesco QQQ, ticker symbol QQQ. This ETF is basically like a mini version of NASDAQ, or simply put, it tracks the NASDAQ 100 index. It's comprised of tech and innovative companies. Again, not surprised at all, their main holding is also Apple. And here are the top 10 holdings if you're curious. Overall, they have a return on equity that's about 30%. It has a dividend yield of 0.57%. It's not much, but given the fact that the tech sector has been growing insanely lately, it makes up for it. It has an expense ratio of 0.2%, and since inception in 1999, it has an average annual return of 8.37%. Currently, it's trading around $292.53. Since March of 2020, when the stock market came tumbling down, tech stocks have been skyrocketing like crazy. I believe they'll continue to do so because that's pretty much the future. And if you don't want to put all your eggs in one basket like Tesla, you can just diversify it into QQQ ETF. But if you want to take a little riskier approach but still want to be diversified, we're going to have to take a look at number 5, ARK Innovation ETF, ticker symbol ARKK. This is an actively managed ETF, which is unique because most ETF are passively managed. This ETF focuses on disruptive innovations like DNA technologies to automation services to technologies that make financial services more efficient. So there's a variety of innovative companies. Typically, their number of holdings ranges from 35 to 55, and currently their largest holding is Tesla. It has a dividend yield of 0.21%. Again, it's not much, but their growth makes up for it. Since inception in 2014, it has an average annual return of 26.7%. Currently, it's trading around $92.36. Their expense ratio is 0.75%. It's relatively high compared to other ETFs that I mentioned, but judging by their past performance, it makes it back in their growth. And if you're curious, here are the top 10 holdings that they have. This ETF has been generating a lot of buzz lately because Catherine Wood, who is a CEO of ARK Investment, is being compared to Warren Buffett. And if you chart Warren Buffett's stock versus the ARK stock, it shows that in these past few years, it has outperformed Buffett's stock by triple-digit percentage points. Disruptive innovation will eventually take hold and companies could skyrocket. This ETF is indeed a high-risk/high-reward type of ETF, but judging by its performance in the past, it does have a long-term potential growth in the future. Plus, technology is not just going to go away in the future, it'll be part of us. Overall, this is for those who are looking to diversify their portfolio and aren't sure where to begin. Again, this is not investment advice. Investing in one stock could be risky. I've taken their cost and performance into consideration when finding these ETF. Of course, there will always be other ETFs that's close or could perform better, but these are the ones I've done research on and have a good track record to prove its worth. So if you like this, please give this a like and maybe consider subscribing for more updates like these. I'll catch you all later.